Hey traders, in this video we are going to talk about the impact of leveraged ETFs. Hey traders, a very warm welcome back. In this video we're talking about leveraged ETFs. What are they all about? How do they work? And more importantly, what's the impact on our bottom line when we hold these things for a few days? So we know what an ETF is, exchange traded fund. It kind of tracks the performance of an underlying asset. That could be a basket of stocks. It could be a commodity, a basket of commodities, a currency, an index. It can be pretty much anything. Biggest ones out there, S&P 500 ETF is called Spiders. That tracks the S&P 500. We have one USO, which tracks crude oil, GLD, gold. We have FAS, which are kind of financial tracking ones. There's loads of them. Go and check them out if you want to see the full list and which are the most liquid. But some things out there, we have ones which are called leverage ETFs, and they are basically double or triple leverage, however you want to pronounce it, ETFs. So in other words, what they do is if they're a double, they will double the performance of the underlying asset. So if the underlying moves up by 10%, if it's a double leveraged ETF, then that ETF is going to move up by 20%. Pretty self-explanatory. Triple, it's going to move up by 30%. We have inverse ones as well, but let's just stick with these leverage ones for now. So the important thing to know is if you're trading a double ETF or double leverage ETF or 2 times performance ETF, that's guaranteed for 1 day only. So on day 1, if we look at an example, if we look at the underlying as starting 100 and the ETF starting 100, so we've got a benchmark and we can see what happens to the value of our investment. So $100, it moves up by 10%, so it moves up to $110. The ETF moves up to $120. Okay, pretty self-explanatory. It's doubling the performance because we're using a double leveraged ETF. That makes sense. Day 1. Now, interesting thing comes from day 2. Day 2, the underlying loses 10% and of course goes down to $99. It's taking $11 off our $110. It's down back at $99. So we've lost 1%. That 10% move up, that 10% move down, we've lost 1% on our investment so far. However, if we trade on the ETF, we bought the double leveraged ETF, we would be down at $96. So we've lost 4% of our investment, just literally with the market almost standing still. And that's what's called volatility drag. And it's very important to note this thing here, that it's reset on day 2, day 3, day 4. It's only guaranteed on the individual day, which is why they're a great vehicle for intraday trading. If you want to intraday trade and you want to get a bit more bang for your buck intraday, whatever that may be, it's why a lot of people put them in portfolios and stuff, because it's classed as a stock and the leverage is restricted with stocks and what have you. But intraday, it's going to do exactly what it says it's going to do on the tin. However, on day 2 and day 3 and day 4, yes, it might do each individual day mirror as it's supposed to, but it's not going to perform anywhere like what you'd expect. So let's look at an example. Let's say we had 3 days in a row where the underlying went up by 10%, whatever it may be, just for example's sake. Here's the underlying here, down here. We've gone from 100, $110 the next day, 121, 133.10. So we're adding 10% obviously onto the closing price. So it closes the day 110, closes the day there. Now let's look at what happens to the double leveraged ETF. 100, 120, 144, 172.80. And we're only on day 3. So for those of you who have kind of looked at this and thought, actually, well, if the market's standing still, then it's quite good because if I'm short, I made 4%. Just bear in mind, there's always a double-edged sword to these things, guys, is that, if you were short and you had a 3-day ripper, you've absolutely been annihilated by this. This is way more than what you'd expect to have if you're just trading the underlying. So this is the kind of important thing. Now, I want to touch on an extreme example of what would happen if the market sat still for a long time and you're trading a triple leverage ETF. Pause the video, wipe the board, put some more stuff on, come back in a second. Okay, so let's look at this example now with this triple leveraged ETF, and let's just see exactly what would happen if we held this over a long period of time to our underlying valuation. Right, triple leverage ETF promises to triple performance of the index, right? So if the index goes up by 10%, your ETF's going to go up by 30%. But obviously, remember that it's only guaranteed for that day. Let's see the effect of that on a multiple period of time. So let's use end days here as equal to 50. So we've got a 50-day period, and let's assume that for 50% of the days, the underlying is up 5%, and for 50% of the days, the underlying goes down 5%. So 25 days go up 5%, 25 go down. What happens to the underlying? At the end of those 50 days, so less than a couple of months, we've got 93.9% of our initial value left. So, you know, it's sort of reasonable volatility, but just treading water, not going anywhere, up, down, up, down, up, down. As I said, your value of your underlying portfolio or the value of the asset you've bought would be worth 93.9% now after that period of kind of volatility where it's just treaded water. However, you look at the triple leverage ETF, that would be 56.9%. And the point is, if you're investing, if you're holding this, you want to hold this for kind of a couple of month period, can you hold that if you are looking for a trade? No, you can't. You know, you could probably stomach that. That's not that big deal, is it? You know, 6% move, 6.1% move to the downside. You've got a wider stop than that. If you've got a longer term thesis, then that's all good. But if you're in the triple leverage ETF, you've lost a significantly more amount of money, which is why, guys, you've got to be careful of this. This is the volatility drag in play, and you've got to be very careful of this. If you're in one of these, it works very nicely. If you're long and it's just rocketing because you're compounding your gains, obviously, because the triple is working on then a higher price from before. So you really kind of get that exponential move in those. But if it's pushing to the downside, or if it's treading water, then you're in trouble. So, you know, you've got to understand how they operate and how they work so that you can use the right tool for the job. They're a powerful tool and can be used well for intraday trading, but being very cautious if you're looking to hold some of these leveraged ETFs over a multiple period of time. Anyway, guys, take care. Good trading. See you in the next one. Bye-bye.